Hi everyone. So today we're speaking to Michael Quinert. He's the chairman of West Wits Mining Limited. Michael, thanks for joining us.
Glad to be here, Dane.
We're running a series to understand gold in the real world. So Troygold's customers and users are used to investing in refined gold in the form of Kruger coins, but they're in a dark vault. So we don't always know what it takes to get it there. Your company, West Wits, opened a new gold mine last year. It's located in the south of Johannesburg, and you're mining the Kimberley Reefs. It's called Qala Shallows, and if I understand correctly, Qala means to start anew, which is an excellent name for something that you're rejuvenating as an established resource in one of the world's oldest gold mining cities. At current prices, you're sitting on a gold pile of around 5 million ounces, or about $27 billion. But for people that don't know you yet, maybe can you give us some background of yourself in mining and capital markets?
Sure, Dane. Yeah, so it seems it's gone pretty quickly, but I've been involved in this game for over 35 years, and primarily originally as a lawyer. My background is working in the ASX in Australia as a lawyer, and I moved back into private practice in the early 1990s. A lot of the Australian market, as you'll probably know, is focused on explorer and development gold and precious metals and mining companies. So my practice gravitated towards that sort of company and helping them list and helping them raise money. So that morphed more into knowing more about mining, working with mining companies, and eventually in about 2005, I came here to South Africa with a client on a project that was going to list on the exchange, and that's how I started to get involved with South African mining, and that's why I'm here. So I've been coming to South Africa regularly since that time, so over 20 years ago, and this gold mine we've been working on a long time, but she's finally in production, and we're really excited about it all.
You started developing this asset well before the gold bull market. Was that just remarkably prescient, or why exactly did you choose to invest years of your life and capital into developing the asset?
I'd like to, I say to some people, Bastian, it's like, it's a 15-year overnight success to get here. But yeah, it's, look, I think with what I saw in South Africa compared to other jurisdictions in which I've operated I think the main appealing fact was that we had gold deposits and bodies here that were really well understood and really some of the biggest in the world. The Wits Basin still produced upwards of 30-40% of the world's gold. So you have to have, there's no point going somewhere where the gold isn't there. It'd be much nicer to mine in some, I'd like to find gold on the Champs-Élysées in Paris, right? But it's not there. So you go where the gold is. And I think if you look at South Africa as a country in terms of investability for the actual resource and the credibility and certainty of the resource, that was the appealing factor to me. Another factor, I think, is that you have a very good legal system. I'm a lawyer by background, I can see that, and I think the courts here are very good. And so that doesn't happen always in parts of the world, in Africa and other parts of the world, Indonesia, Southeast Asia. So I saw that as a very credible thing. And I think, South Africa has a very sophisticated infrastructure compared to all of these places, and let's face it, it's been unloved. So there's an opportunity, because people weren't seeing the value here, and I think there is great value here. So that's, in terms of deciding when to do it, though, the main things, and I think what's happened, the delays we've had in getting the project through regulatory approvals and funding, we can now say we're really clever that we left it this long to the gold price is riding where it is, but the reality is the project would have worked at much lower values. It's just going to work better now. So
That's fascinating. But Qala is the first new gold mine to really come online in South Africa in the last 2 decades. Why is that? And why was Qala uniquely profitable or uniquely better suited to come online?
Yeah, I look at it a bit broader than that. I think there's lots of opportunities and lots of mines here that should be brought back into production. And that's been my belief for a long time. I think there's been geopolitical, political issues and other issues that have affected South Africa's reputation and its investability that have held it back. And I think there's been obviously some political issues probably that are now being dealt with. So I don't think it's a matter so much of mines not deserving to be brought into production because of the geological issues and so forth. It's sort of been extraneous factors that have held it back, and they're starting to resolve themselves. So, yeah.
That's promising. I think what we wanted to do is actually also dig into the mining itself, or mining in detail. So how do we get the element of gold out of the ground and into a bar or coin format.
Well, bear in mind you're talking to a lawyer here, not a mining engineer, but I'll do my best.
We're going to put you on the spot and ask you, so how do we get gold from a gold seam in hard rock out?
Well, one thing I've learned about mining, Dane, is that it's different in every mine and different in every jurisdiction. So not one ore body is the same. But what you have here in the Wits is an ore body that's very well understood. And if you look at it in terms of its three-dimensional presentation, it's a very predictable ore body. It moves at about a 45-degree planar dip, and so people can understand how it's mined. It's also very narrow, which is different. It's a narrow ore body. Most of our seams or the stopes are running at about 1 metre to 1.5 metres in width. So that takes its own expertise. Now, South Africa has been mining those sorts of ore bodies for over 100 years. And you've also mining the platinum fields in the Rustenburg area the same way, because they're very similar. Rensky Reef and that are very similar. So why come here and try and reinvent the wheel? We started off here with Australian geologists and engineers. We got rid of them years ago because it is better to use the local people. So what we're doing in terms of extraction is we're using conventional methods that have proven to work here for a long time. So a lot of handheld equipment, but also merging that in with modern equipment, such as we're using, for example, we're using hydropower to power our drills and things rather than air, because it's a new modern system that's much better. And by the way, our hydropower system's been manufactured half an hour from the mine site. There's a lot of expertise here in doing that sort of stuff. So I think that's how we extract the ore. We extract it the way you've been doing it here for 120 years.
All right.
By handheld methods, stopes, bringing it out. But we're using trackless vehicles rather than the old-fashioned vertical shafts. We're using a decline. So it's a marriage of modern methods and equipment with old systems. Yeah.
So effectively, it's a dipping seam, almost like a layer inside a cake. It dips at an angle, and you guys are drilling and blasting that out.
That's a good way of describing it. Some way I describe it to some people, it's like a stack of soup bowls, where the seam is coming to the surface and going at 40. Yeah, but that's about what it is. And then there's, the reefs we're mining at Qala, K9A and K9B, they're all part of the Kimberley reef structure, but they're really only 15 metres apart. So we're using the same infrastructure to access both stopes.
Brilliant.
2 questions. One more on the capital raising side. So mining is very capital intensive.
Yeah.
How do you determine the feasibility of the project, and how do you go about raising the capital for that project?
Yeah, it's quite sophisticated. Over the last 30 years, it's changed a lot. First of all, you need to have a resource, and you now need to have your resource compliant with a code. And in our case, that's the JORC code. The SAMREC code operates in South Africa. It's very similar. They're virtually the same. So you have to establish, if you like, the quantification and grade and structure of your resource in a way that you can report it in a consistent, compliant manner. So that's where we start, okay? We start by drilling out and taking all the historical data we have and all the sampling we have and taking that with it through a process to develop a reportable resource. And that's quite heavily scrutinized. It has to be signed off by a competent person. But basically what that's doing is establishing to the level of professional consistency, the actual quantification and grade of the resource and where it sits. So we've done that. And once we've done that, then we move into what we call basically feasibility studies, which start with a scoping study, again, done by independent experts. In this case, we bring in more economic factors and we bring in more engineering type factors rather than just the resource. And we did a scoping study, and then that graduates on, in this case, we went straight to a definitive feasibility study, or what used to be called a bankable feasibility study. So the bankable, or in this case, the definitive feasibility study, is designed to underpin the economic viability of the mine project and the mine plan. You have up to a level of tolerance of about 5% variation. So that's a very complex process, and that took a long time, and that definitive feasibility study probably runs to 250 pages of technical reports and graphs and input, and then that's what we've done. And we've had that upgraded or reviewed twice because of the rising gold price and because of alterations to our mine plan. So it's not just like in the old days on the Rand, they dug one hole and said, oh, that's where we go, because we've hit the reef. There's a lot more. So you're not going to be able to raise money on the ASX or any of the major markets. The TSX, they have their own standard 43101, a different compliant project. So any of these markets, and therefore the capital that comes from these markets, will only come to you if you've actually done that work. So we've done all that work.
And so if you are drilling and calculating effectively what you would say is a gold resource in the ground, Are you saying that these studies apply economic methods or price factors to then say, we think we can extract X amount or X percentage of that resource profitably?
Correct. So when you have a resource, the resource is at various levels of confidence based on its description, whether it's inferred, indicated, or measured. And then nowadays with the JORC code, there is a requirement that there be some grounds for to believe it can be economically extracted. That used to not be the case. In 2012, they changed that. So we have to have some economic extraction validation. But then taking it into these feasibility studies and culminating in the DFS, the definitive study, that validates the economic viability, and that converts some of our resource into what we call reserves. So it becomes economically extractable. So it's, I suppose what I'm trying to give your listeners and viewers, it's not just a random thing. It's quite a complex, detailed process to get to this point.
So if you look at gold mining from a very high level, can you distill a few factors that determine the success or failure of a specific gold mine?
Yeah, I mean, it's a hard question. I suppose you can look at the various factors, and then they will apply differently in different jurisdictions and different mines. I think one of the things, as I said earlier, is do we understand the ore body and what it is? And here we do. This is the most well understood ore body of gold in the world. So that's great. There's a massive amount of data on this ore body. So that's critical. Grade's important, but yes, grade can also depend on where you are. I mean, grade at where this is Qala shallows. We're starting at shallow areas, so the grade doesn't have to be as high at shallow because we're not spending all that money to get to these great depths. So grade is important, but it's not everything, you know. So I think jurisdictional issues such as, and the JORC code takes that into account as well, the legal situation, the political situation. A lot of people are going to East and West Africa. Well, you know, I would feel there the political instability of coups and things is an issue. Another thing about South Africa, I think people overseas forget, is this is one of the only jurisdictions in Africa that's never had a coup. It's still a republic by democratic election. You know, I mean, really, that's fantastic. We want that, and yet we're going to invest in places like Burkina Faso and Mali and places. And you know, there's a lot of Australian money and American money going to those places. And I go, geez, guys, you know, what's the jurisdictional risk there that you have your mine taken off you tomorrow? So those things are all going to impact. But you know, I think here the main thing was. The other thing is, you know, the ability to mine and the accessibility of services. I mean, we're just north of Soweto, so we have mains power. We have, as I said, our equipment's coming. All our equipment suppliers are coming within half an hour, 40 minutes of the mine. You know, we have a lot of mining expertise in Johannesburg. Basically, every mine in Africa gets run by someone coming out of this area. They're educated here, you know, in terms of training. So yeah, I think there's a lot of advantages here. But they're the sort of things we would look at. Yeah.
And people, what role do they play?
Very important. I mean, particularly when we're looking at a mine like this where there's a lot of handheld equipment. You know, we're going to be scaling up over the next 3 years to a complement of 1,000 people underground working on this mine. So we have to have the people that can be trained and understood and you know, can be safety conscious, everything else. That's very important. Yeah, so the people, and also the expertise at the higher level of the company, the engineering and, you know, the geology and those sort of people. And frankly, as I said, we find that in South Africa. You know, I've brought people over from Australia, but really I prefer to stay with the local people who understand it, and they've been well educated here. I mean, Australians are really good at open pit mining. We don't do much open, or you call it open cast mining. We don't do much open cast mining here now. So that's, you know, it's horses for courses, isn't it? And we're using the people that are familiar with the local lay of the land.
Well, if we take into account this lengthy and sort of arduous process to get to a mineable reserve, effectively,
yeah,
and it takes multiple years. If we look at, you know, at the time of recording, gold just made a new record high of over $5,500. So something like that, where there's a gold bull market or a re-rating in the gold price up, how does that impact a producer of gold? Does that just automatically mean just profits go up, or do you look at the asset or your reserve completely differently?
Well, both. But first of all, you know, we say that we don't design and build mines over these longer periods based on our view of the gold price, because it's one thing we don't control. You know, we don't control where the gold price is going to go. So you have to have some basic faith in it. But in terms of building our feasibility models and our financial models with banks and others, we're using consensus prices put out by Bloomberg and people that are still sitting at like under $3,000 an ounce. So they're not going to bank it on because the spot price is at 4,800. It's a very conservative view they take. So those things are not going to impact our sort of long-term plans for the mine or our funding models for the mine. But what this sort of new era of gold price is doing is causing us to look back at how we mine it and what our mine plan might be, and also what our cutoff grades, for example, might be. So, for example, we're currently doing a review of our resource, and part of that review is based on some new ground we brought in through a prospecting right. But part of it's also on the basis that in a lot of the areas we're mining, we can now afford to mine at a lower cutoff grade. So in our previous mine plan, material that was under a certain grade was deemed non-viable at, say, a $3,000 gold price an ounce, but now it's become viable because we're sitting at 4.5. So we will, instead of leaving that behind, we're going past it anyway, we'll now take that. So it's going to change the mine plan, probably accelerate production and increase production overall. So it's a constant process, but particularly in this gold price environment, we're having to keep going back and looking at those sort of things.
And if we can assume, when you say a cut-off grade, meaning if the gold price goes up, the grade of gold per ton that you can mine profitably would reduce.
Correct. Right? Yeah, correct.
So you could effectively, of your resource, if the gold price jumps like this, you could actually bring more of those ounces to market.
Yeah. So, for example, under our definitive feasibility study, one of the key elements of that study is what is our all-in sustaining cost of production, which includes rehabilitation and depreciation, everything. So that this mine has come in at a steady state under $1,300 an ounce production. Okay, so and that's based not just on our guessing. Again, that's based on let contracts and contractors. So our costs are sitting around that level in steady state production. With a gold price now, we're sitting. You can see the margins quite large. So that's. Our guidance starts on our cost base of what's viable to mine, but we'd obviously put it at a higher level than that in case our costs go up. So our cutoff grades were at 2 grams a tonne, and they were set based on, I think, a 1750 sort of gold price we were using. But we've now got cause to raise that substantially because I think we're going to raise it to 2,850 in the next study. So that'll translate into being able to lower our cutoff grade.
Operationally, how often do you review that cutoff grade?
Well, it costs money to review it, so you only review it when it's going to make a material difference. And so, but I think you both agree, and your viewers would see that it's been a pretty amazing last 6 to 12 months in the gold market. So there's been we re-released our DFS only last July, and we're already looking at stuff in it again. So it's not things you can't just turn it on and turn it off like a tap and just recalculate quickly. So it's quite a process, but we are having to do it more often. Yeah, so. We've told the market currently, as I said, we are reviewing our resource statement, based on, and that will also feed then into our mine plan because we'll bring more gold into the process, into the more mineable gold into the mine plan.
So just to understand, so that's for your resource statement, but say operationally on the ground, what is actually being mined, is that reviewed a bit more frequently?
It will be, yeah, but it has to follow from the resource statement.
Okay.
I mean, we can't plan to mine gold that's not there in our, so that it's a staged approach. So yes, we will restate our resource, and then also our geologists and our engineers know where that is then. So now, for example, if we lower the cutoff grade, this stope, that stope, and that stope are now going to be mined so now we have to change the mine plan. But that'll feed into the mine plan. But it's in sequence.
That's very cool.
Yeah.
So if you've drilled and blasted that rock, you've hoisted it effectively to surface. Now that, just to give people listening something to understand the scale of this, 1 ton of rock contains about a teaspoon's worth of gold, right?
It'd be pretty high grade if it's a teaspoon.
That'd be pretty high grade. So probably half a teaspoon.
It's not a lot, yeah.
Right, for a ton of rock. It sits on surface. You've spent the money to drill it, blast it, hoist it out. What happens to that ore from there once you've extracted it?
Yeah, just on that point though about the teaspoon, I mean, our cutoff grade at the moment, which may come down, is 2 grams a tonne. So at 2 grams a tonne, you can say a tonne of rock, you're only getting 2 grams of gold. An ounce of gold, which people know from the market on pricing, is 31 ounces or 31 grams. So you can see there's not a lot of gold in a ton of that rock, but it's worth mining still. So, so what happens to it when we get it to surface? That was,
So from there, what do you guys do with it?
What we're doing is because Johannesburg has a plethora of underutilized infrastructure on gold processing. First thing is we're not having to build a plant. So we're treating our ore at a plant owned by a large company in the area, and so we don't have to build the plant. We think that's probably saved us about $250 million US, not having to build a plant. So, so we will haul the material about 40 kilometres to that plant, and then it goes through the processing cycle. I don't know if you want me to go through that, but it's pretty basic. I mean, they crush it first into smaller section, then they grind it into a really fine powder, which is what you see on your tailings dumps when the wind blows.
Yes.
That's that powder. And then they put it into solution in carbon and leach. And basically by introducing cyanide into the circuit, they melt the gold out of the solution. And then by introducing carbon, the carbon attracts the gold and they extract the gold that way. And they concentrate until they get it to a point where they can they take that carbon out, they put it through an elution circuit to release the gold from the carbon, and then that goes into a smelter. So what we end up with at the gold plant is what we call a doré bar, and the doré bar will be somewhere between 85 to 87, 90% gold. It's not pure, and that's all we can do in the plant. And then we have to take that material to Rand Refinery, in this case in Johannesburg, and they will take it to 99.999% gold, as you know, to proper pure gold.
And once it's in that refined form, where would the gold bullion then go?
It leaves our hands. You know, we sell it to Rand Refinery in effect. So we get paid by them. What they do with it is distribute it through the international market. You know, you guys know more about that than me.
So the processing plant would create a doré bar of gold, a couple of kilos worth. You transport it to Rand Refinery. They would refine it to a higher gold content or gold quality, like you said, 99.99%.
Yeah.
And then they would create Kruger Rands or bars, and they would ship that into the markets of London or South Africa or New York.
Yeah, and I mean the doré bars themselves are usually 18 to 20 kilos. They're not one or two, like they're quite heavy. So it's that each of those would be containing almost 90% gold. So yeah, it's very hard to pick it up with one hand, a doré bar. It's only that big, but they're hard to pick up.
That's
It's one of the great things to do, actually, which is I've done a couple of times, and we'll be doing in March when we do our first pour, to actually pick up a gold, even a doré bar, and see how heavy it is. And people who are looking at it don't understand how heavy, it's one of the heaviest, densest things you can handle. So
we always tell people it's sort of the gold bars you see in the Bond movies, and sort of it's sizable.
Yeah.
But I mean, effectively that whole process. There are big risks to get it from a ton of rock to an end bar or coin. Just high level, when you look at your mining company or your mine, what are the biggest risks that you look at and try to, I guess, mitigate?
Yeah, the whole mining game is about mitigation and taking steps to de-risk. So obviously, on the geological side, we've de-risked as far as we can by delineating the resource under a really compliant, strict code. We've then gone through the process of testing all the economics and the engineering through the DFS. So that's all. You can't de-risk entirely, but that's the process we go through. When you've got there's still risks in mining. Obviously, the commodity price we can't control. Obviously, there's some risk on, even in a higher gold price environment, there'll be pressure on costs because everyone in the food chain wants to get a bit more of the action, so people will charge more. So that's a risk to us. But in there's always the physical risk. I mean, mining underground, there's modern systems are far more, safe, I suppose, than they were, and we know far more about dikes and ore bodies and things. But you still have that fundamental risk. It's a dangerous environment. You're underground mining, so you can have risks of, geological events, collapses, people doing the wrong thing. You're using explosives underground in confined spaces. So all those things are the things that I think, you don't want to have that sort of accident on your mind, because it's obviously going to have an impact on production and also an impact on your reputation and on your workforce and your stakeholders. So they're the sort of risks I worry about most. Are we doing things safely? Have we got the right people, professional people in the right areas? Because that's really, the execution of the mine plan in a safe way and the discipline on cost control, I think, are the two main things we can control, and they're the risks we have to look out for. We can't become complacent because we've got a high gold price, you know. It doesn't matter what the gold price is. If our mine collapses and we kill people, it doesn't matter, you know. So that's our main focus.
Actually summarised the risks pretty well, but perhaps if I were to ask, if you look at the South African ecosystem, when gold mines do fail, where do you generally see them failing? Is it in the regulatory arena, geology, financing, or operational?
I think in South Africa, mines, it's not so much fail, but they've tended to close. There's been some because of, you know, cost pressures through organised labour or other issues, or that sort of agitation, you know, semi-political here sometimes too, because there's a close connection between some of those groups and the politicians and so forth. So that's been an issue. I think more often though, what I've seen in South Africa is there's been very deep mining, you know, because some of these ore bodies have got very deep, and deep mining becomes very complex and difficult, and one thing goes wrong and it can cause a whole lot of problems. So it's more dangerous, it's more costly, and it's more just hard to make it work. Like if you think about it, if you get a shift come to work at 6 a.m. and they're working at a stope face that's 2.5 kilometres underground, it's going to take you 2 or 3 hours to get them there. And then they're going to have to work for their little period and get back again. So, you know, it starts to become less and less viable. And also if one thing goes wrong, the truck taking them down breaks down or something, you know, then not the whole shift is thrown out of sequence. So that's the sort of thing I've seen more in South Africa, because you've been undertaking this sort of really deep mining. That's why Qala shallows attracts me, because we're not mining deep. And in the whole life of mine, in 17 years, we get to 850 metres, which for you guys is nothing, you know, in terms of depth. We've got mines here that are working at 3 and 4 kilometres depth. I also think the thing that happened here was the proliferation of really large companies that took sort of macro views of the jurisdiction, and when things changed in the 90s with the political upheaval and the end of apartheid, that moved offshore, that there was this mindset that mining here was finished, and that sort of did, you know, if I mean, enough people think it sort of becomes self-fulfilling, and that's sort of what happened here, whereas we're looking at it going, hang on, they've got some really good assets still here, why are they doing this? But it's because people got caught up in their own thinking or mindset here. So I think that's so. But in terms of other factors, you know, I mean, generally, yes, when the gold price in 2002 got down to, I don't know, $250, it was really hard to make these mines work at that level. So that's probably where a lot of them shut around the start of this century, when, you know, some of these old mines were still going. The big guys had left, others were trying to take them over, but you had a gold price of, I think at $200 it bottomed out at in about 2001. Well, it's pretty hard to make money at that. So
that's I think we're going to leave it there at the gold mining side and almost segue a little bit to the gold ownership side.
Yeah.
I think from a producer's perspective, you know, perhaps you're an investor personally, but how should people think differently around owning physical gold in bullion form versus owning a share of a mining equity like West Wits?
Well, I would have said, you know, things change with the gold price being so volatile, but generally what I would have said normally, and in a normal world, and the last 6 months hasn't been that normal, is that, you know, gold companies themselves, I suppose, have a higher risk but more leverage. And the higher risk is that you're dealing with management, and management can pay themselves too much or make a bad decision, or, you know, that's sort of, and the things that can go wrong with an operating mine, you're exposed to by investing in a company. If the company get it right, you can get a lot of leverage because it'll go well. In physical gold, well, you know, you've taken all that risk out of it because you're in the physical asset, and that's a different market. People are going to buy gold or sell, you know, so you're sort of de-risking. You know, it's why streaming companies started, isn't it? Because streaming companies wanted to take themselves above worrying about management. I mean, they've still got to have a viable mine to get their stream, but I mean, basically, it doesn't matter that the mine's not making much money. As long as they're getting their stream, they're fine. And that's so streaming is somewhere between owning physical gold, I suppose, and owning shares in a company. They fund a company with a streaming allocation on the basis that they're de-risked. They're sort of taking themselves, insulating themselves from the management, you know, problems. So I suppose that's the difference.
But that key word of leverage that you talk about, is that effectively the fact that a mining company might be able to produce at $2,000 an ounce, and the gold price can be 5,000 or move to 5,500, and you as an investor, you can unlock that potential margin. Whereas if you're holding the physical, you're looking for you're buying it at the gold price or close to it, but you're holding it over a longer period for safety and security and steady ownership against economic systems.
Well, here's a good example of it. I think to illustrate your point is that, if you own physical gold, that's the cost. You're buying that gold, and that you look at what the gold market does, and that's what you're going to make or lose. If you look at a company like West Wits, for example, which is starting production properly now and is funded, our net present value post-tax under our DFS, if you adjust it for the current gold price, or even our sensitivities run out at 4,000 something, because it's gone too high, but we're talking about $1.5 billion US NPV post-tax. We're getting close to that now. The published one's about 500 million, done at the 2,800 price, but now we're sort of up well over $1 billion. So let's say 1.4, say. So 1.4 billion US dollars. The actual market capitalization value of West Wits today, using US dollars, is probably 200 million US dollars. So there's a difference between the $200 million market cap value of West Wits today, as opposed to 1.5 billion, its net present value of its project. That's the leverage. If we get it right, we're going to keep taking the value up towards that 1.5. And that's where the value is to be made by investors in the shares.
That makes a lot of sense. And effectively, a net present value is looking at all the cash flows that you could earn out of that on a net basis, or profits out of that project, and then sort of discounting it or taking it to today's money. And you're saying that should be about 1.5 billion, and you can acquire ownership in a company that's worth $200 million, and that.
Correct. It's like saying if I'm going to earn that much over the next 15 years of this mine, as a shareholder, what would that amount of money be worth today to have the equivalent return? So it's getting up to 1.5 billion. So we're going to make a lot more revenue and profits than that 1.5 billion, but that'll be over time. So it's discounted back for the present value. Yeah.
So what would it take for your market cap and your NPV to move closer together, and how does that happen?
For me to convince the shareholders in the market that we're going to execute the mine plan in an efficient manner and with good cost discipline. And the more we can convince them of that, like for example, West Wits has gone in the last 18 months from a market capitalisation of 70 million Aussie dollars to now about 300 today. Okay. So you can see we are slowly convincing people that as we tick the boxes, this is happening.
Okay. Yeah, it's all about execution.
Yeah.
You've made a great explanation around controlling the factors that you can control, and the project and the asset itself, and we've talked about the gold price that you can't necessarily control, but surely as somebody that has to steward this asset, we'd like to ask you what's your take on the gold price going forward. We put you on the spot. Maybe we don't ask for a prediction.
I can talk here I have actually got an economics degree. I should have said that. So I did study economics, but it's hanging on my wall somewhere. But look, I think it's good. And I'm not just saying, I'm not here to talk my own book. And I think it's good for obvious reasons. We have a world that's more uncertain than it's ever been for a long time. We have fiat currencies that are debased. Politicians keep printing money to pay debts they can't afford. They're building infrastructure they can't afford. They're trying to win votes with money and things they can't afford. So at the end of the day, the investors and the market, eventually, the market's the great leveler, and they work out that this is not a good place to be. That's why people have been deserting the US dollar. And where do you go? Do you go to crypto? I'm not going to crypto. I don't understand it, but people will. Some people will and some people won't. At the end of the day, the good thing about gold, I think, is that it represents a physical asset that's tactile, that people can understand, and that it actually has industrial and jewelry type applications, but it also has an inherent respect as a store of value. And I had an old mining client of mine said once, I think it's one of the best ways to illustrate the validity of gold as a store of value. If you have a 2-year-old sitting at a coffee table and you put a American dollar bill on the table and a gold coin, a Kruger, and say, which one do you reckon he's going to pick up?
Yeah. He's
going to pick up the gold coin. That's because people have this attraction to this metal, and they can take it, they can store it, they can move it around. They can, if you're going to leave a country in a mess, you can't take a lot of you can't, if the banks are closed down, but you can physically take the gold in the back of your car, theoretically. So there's a lot of things about gold that I think people over millennia have understood that it's a store of value. I think it was Nixon in 1972 that decoupled the gold standard. Up until then, the gold standard was in and from around the war or the Depression time. Before that, people were using gold because it was a tradable currency. It's only in the last sort of 50 years we sort of decided we didn't need to have a store of value sitting behind the paper. And now people are starting to realise, well, hang on, it's better to have something. And that's what the Chinese are doing, let's face it. They're buying a lot of gold, as the Turks are buying a lot of gold. They're all doing it because they want to show the world that our currency means something. We have this reserve here and this backing. And
solid, yeah.
It's that disconnection the American markets have had between, we all went to this great US dollar, almost like worshipping it. And at the end of the day, it can only be as good as the functioning economy and the certainty of the American economy. And that's coming under question now, and people are starting to question it. So I think long term, gold and the gold supply is not like it is like Bitcoin like that. You can't just, God's not making any more gold.
Yes.
It's finite and it's hard to develop and it's hard to get out. So it's not going to be flooded.
So the supply is pretty naturally constrained.
It's naturally constrained. It's funny. Some people have always understood the power of gold. I read an interesting statistic from the World Gold Council recently that 11% of the world's gold. 11% of the world's gold's where it is now. Mm-hmm. You might think it's in the Bank of England or it's in Fort Knox or it's in here and it's there. It's in Indian housewives' cupboards. Because they understand the value of gold and they've always kept gold as a store of value and for other reasons. But it's
hanging on their ears or in the cupboards.
It's there. It's there. They reckon that's where 11% of it is anyway. So,
and if we look on that note into the future, specifically from a technology perspective, what do you think the future looks like for the gold mining sector? If you look at advancements like AI and robotics specifically, what do the next 10 to 20 years look like?
It's just like we've seen technology over my lifetime, change things dramatically. And I think the opportunity's there. I can't say I know exactly where it's going to go, but take the Wits. I mean, our area where our footprint is originally had a JORC resource in 2000 of 12.8 million ounces. We've got 5 at the moment. So the reason we don't put a lot of that onto the JORC table now, that old gold that's still there, is because it's underwater. It's been flooded. So we say at the moment it's unviable to extract it. But if someone comes up with a drone that can actually go underwater and start extracting it, or if gold keeps going up, we plug and pump it. There hasn't been a lot of technology advancement in gold for a long time because people have just done it the way they've done it. So now that it's interesting to see what this gold price is going to do, because now this gold price is so high, people start saying, well, hang on, if we actually invent a new thing to extract it. A friend of mine, Neil Pretorius at DRD, has been on about this for years. The gold industry need to get better at technology development because you could actually really increase production.
As a point of interest, just on a separate note, why don't you plug it and pump the water?
Well, it's becoming something we will look at because it's there. I mean, we know it's there. And we didn't do it in the past because the costs were seen as prohibitive relative to the price of gold. But it's now it's clearly becoming more viable at these sort of gold price levels, and we will look at it. Yeah. We will be looking at it.
I hope in time that you can, you almost have an R&D department that you can test new innovative technologies as they come into market. Because I think, like you said, gold's mainstream now. So, in a world of SpaceX and humanoid bots, I think we'll hopefully start moving into some technologies you guys might be able to use in the near future.
Yeah, I think technology in the gold industry too has been sort of, it's been only driven by the companies themselves because you haven't had a lot of government, whereas other areas like medical research and things, there's all sorts of people looking at it in academia, and we haven't had that in the gold industry, and that's probably where we need it. You might have a lot of students, PhDs in universities here and overseas studying medical issues or even chemical issues and things, or quantum computing and things, but they're not studying how do I get more gold out? And if that changes, then it could change dramatically. Yeah.
Awesome. Well, we look forward to some of the Qala Shallows gold being in the Krugerrands of the Troygold customers' gold, and we'd like to think that you flew all the way from Australia for this interview. But thank you for being with us, and we are truly appreciative of it, Michael.
Thank you for having me. Anytime.
Thanks, Michael.